let's get into the overall macro picture and global markets largely recovering from Liberation Day. Is everything resolved then on the macro front? Let's discuss with Cameron Curko from Pitcher Partners. I'm guessing not, Cameron.
Yeah, I think that's a safe assumption. Based on the share market reaction, you'd say, everything's rosy, but what we're seeing is just a slow move in train wreck of sorts. So it's not coming through a lot of the hard economic data yet, but we're starting to see surveys really show some alarming trends in consumer and business confidence. And you're starting to see anecdotal reports. There was an interview with the head of the Port of Los Angeles, for example, last week, where he was flagging just how much trade is just going to dry up overnight in the space of the coming weeks, and the job losses and that are going to flow from that, as one example.
So what do we read into China today cutting its RRR ratio on the back of the worries about the impact of the tariffs on its economy, and therefore what that could mean, my previous guest saying potentially deflationary pressures for other countries outside the US?
Yeah, so with China, they've been walking a bit of a tightrope when it comes to the monetary policy angle. I'd say what's more relevant there is the continued extension of their sort of, it's basically a household swap-in program, which on the retail side has really underpinned consumer spending over there. In terms of what the Chinese are doing for their economy, look, reality is their economy has been going through a period of weakness. They've been trying to export their way out of this situation, but we have seen some signs from policymakers that they're actually confronting the problems at home. And realistically speaking, deflation is really just a continuation of what we've seen in the last couple of years.
So with this pain set to continue, what does it mean more broadly for the tariff implications across this region?
So again, this is going to be really nuanced. So we've seen the suspension of the major tariffs, and that gives us some short-term relief. But that's still conditional on whether or not we actually see trade deals resolve the situation. What we are basically looking at as our near-term view is really weaker growth, to put simple. Like, trade is going to be impaired. The actual extent is extremely uncertain at this point. We're still seeing tariffs being weaponised for, frankly, random causes, like the US film industry this week. And look, the path of least resistance now is slower growth. We do see some meaningful policy support in terms of government spending, rate cuts and the like, that while we do see risks of recessions rising, we think they're being still somewhat overplayed because the policy support is meaningful.
All right, well, let's drill down then into how people can make money. Looking broadly internationally, what sectors, areas are you looking at?
Yeah, so one area that's been a really good benefit for us after being a bit of a laggard with the Mag 7 has been in your ex-US plays. So that could be things such as infrastructure, for example, where the likes of Vinci and Aena in Europe have been really good stalwarts throughout this period, with strong secular tailwinds benefiting from tourism traffic and the likes of Aena, which for context is the world's largest airport operator. Other areas that have been beneficial have been your traditional safe havens, things such as healthcare, consumer staples as well to a lesser extent. But I think the thing we're seeing for our clients, and more broadly speaking, is you have to be incredibly nuanced in your approach, because frankly, even though we saw some pain in the share market, the valuation you're seeing in some stocks is still gigantic premiums that are being paid. So Costco, for example, great business, excellent sort of fundamentals. You're still paying tech stock multiples circa 50 times forward, which again, like, do you take that trade? We think there are other places to park client funds.
And locally, I mean, we're calling it confession season at the moment. We're hearing from a lot of companies, WiseTech flagging the implication potentially of tariffs. I think Ampol today has too. What do you look at to shelter in domestically?
So domestically, it's a similar playbook. So your traditional safe havens, such as utilities and healthcare, do have a role to play. I know some people, certainly judging by flows, have been sheltering in the banks. We still have some caution there, just given the scale of the valuation premium you're still paying today. There was some weakness in the March quarter, but that's basically evaporated now, and we've got CVA back at 27 times forward is probably the most egregious example. And the other thing to shelter in would probably be on that technology services side, where there are businesses that have sort of long-term fundamental drivers. So shift to the cloud, for example, in the case of Technology 1 and 0, where again you are still paying some sizable multiples, but we do think the growth prospects are still there.
And the other aspects, bonds, gold.
Yep. So, okay, bonds have been extremely on the nose for quite some time. If you look at the trailing 3-5 year returns, they've not been a happy place for traditional investors here in Australia. That being said, we have seen the fundamentals shift. You've now got a case where you are still getting meaningful yields on particularly longer duration assets. You've now got a technical term positive convexity. So the non-linear impact of rate cuts is going to be that bit more supportive for bonds. So we do think that they still can play a role in client portfolios going forward. Other alternatives, realistically speaking, unlisted has been problematic until the IPO markets, both domestically and globally, really reopen. But we think nimble players can play a role there. And in the liquid alternative space, funds that can profit from volatile market conditions, whether in bonds or equities, we think can play a role. And we saw that in the last quarter, where clients with exposure to your sort of cooler bars and Fort Lakes, which look to be both long and short fixed income products, really benefited from those volatile market conditions and played an important sheltering role.